I am Kathleen Smith, chairperson of the Mentors, Entrepreneurs and Leaders Group, who are also known as the MEL Group. I'm joined today by a fellow MEL Group member, Nick Shepard. Nick has over 50 years of work experience in roles including senior general management and finance. From 1989 to 2017, he ran his own management consulting and professional development company. Although semi-retired, he now spends some of his time getting people to focus on the critical strategic importance of human capital and organization culture. Nick has recently published a book, How Accountants Lost Their Balance, How the Profession Has Drifted Away from Reality and Must Adapt to an Intangible World. Nick, what types of items are included now when a company creates their annual financial statement?
That's a very good question, Kathleen, and thank you for giving me the chance to talk about the book. What typically happens today is when you get a financial report, it's aimed to do just that, report on financial information. And although times have changed, we're doing that the same way that we did it almost 40 or 50 years ago.
Apart from regulators, who is this statement prepared for? Who uses it?
Another great question. Typically, the external reporting focuses on investors, principally investors and regulators, to make sure, number one, the company is in compliance with what they have to report, which is laid down in various legislation and companies acts and things like that. But the other is that people who invest in the organization want to know two things. They want to know, number one, are you making any money for me? Because obviously they want a return on their investment. And they also want to know if their money is safe. So they want to know, what have you done with my money? Where is it? So those are the two principal things and the people that are looking for that.
When you and I were talking earlier on, you mentioned a company in the UK. Can you say more about that?
Well, Carillion. It was a company in the UK that some years ago, I think it was 2017, got a clean audit report. So in other words, the financial auditors went in and they verified that everything seemed to be in compliance with the various legislation and accounting standards. And they gave the organization a clean bill of health. And that includes, one of the things that the auditors are supposed to report on is something called that the company is a going concern. And that isn't accounting terminology. That's a fairly straightforward term. A going concern means that it can continue to operate. And that was in March, I think, of 2017. And one of the large auditing firms, I won't mention them, but you can find their name if you read the book. One of the large accounting firms signed off their accounts as acceptable. The company, within 3 months, in July of that year, announced that they were surprised by an over £800 million loss that they were going to make related to things that they didn't really know about 3 months before, which obviously seems quite surprising. And once this was investigated, it turned out that, in fact, there were very serious problems for the company as a going concern, and indeed it wasn't a going concern. And within another 15 months, the company was basically in liquidation. And it was so serious that there was a parliamentary committee formed that was very, very critical, terribly critical of the not only the accounting firm, but also the management of the group. In other words, there was things going on in that organization that the annual report to shareholders just didn't catch at all, which meant there were investors whose money was at risk, and they really didn't know it.
You were also telling me earlier that intangibles take up a great deal of how much money some companies spend, and it's not captured in financial reports.
No, that is one of the reasons that essentially I think we're having a problem with financial reporting. It's because if one complies with accounting standards, then there's a lot of things that organizations spend money on, which these days are the things required to allow it to continue to be a going concern. And these are things like, training and developing your employees, developing a good team spirit, developing a good culture in the organization, developing great relationships with your suppliers. In these times of global trade, it continues. It includes building global supply chains. And I mean, all of these things require a lot of money to be invested in them to make them work effectively. And the problem is, from an accounting point of view, all the money that's going into doing those things is essentially written off as an expense. It's a charge against the current year's earnings, which essentially says there is no future value in these things. Whereas if you buy a piece of equipment, you put it on an accounting statement called a balance sheet, which says that you don't really have to charge this against earnings because it has value over a long period of time. And the challenge is that these things called intangibles, whilst money is being spent on them, and they certainly impact where the shareholders and investors' money is going, there's no visibility of that. You can't see where the money is going. Unlike if you buy a piece of equipment, you can see where the money went. It went onto the balance sheet for what they call a tangible asset. And unfortunately, what has happened in the last 50 years, and this has happened gradually over time, is that if you go back 40 or 50 years, 85 or 90% of what the investor owned was represented in the accounting statements. In other words, the investor could see 95 cents on their dollar on the balance sheet. Today, that number is closer to 5 to 10%. In other words, an investor is looking at these financial accounts and saying, well, number one, where did my money go? You're making a profit, but that's great. But 90% of my value is made up of something that I can't see, basically. It's certainly what makes the company valuable, but as a shareholder, I can't see it. I can't see how much you're investing in it. I can't see whether you're maintaining it so that we can continue to operate in the future. And I can't see whether you're depleting it, which some organizations do. They sort of push their employees hard. They abuse suppliers. And over time, what happens? These capabilities that they've spent money on developing disappear.
So in your book, we'll be getting to this, but in your book, you are supporting the move towards a different way of reporting what are now considered intangibles. So I'm going to jump the gun and ask you if there's any kind of a move towards increased support generally for this expanded reporting of intangibles.
There is. It's one of those things that everybody knows it's an issue, but nobody's really sure how to fix it. For years, accounting has actually been struggling with this, and some of the audience may be familiar with something called goodwill. And what goodwill is essentially if you come to me and say, I would like to, I'd like to sell you my company, and I look at your company and on the accounts, it says it's worth $100, but based on the profitability it's generating, it's actually worth $1,000. Then to buy it, I will probably spend $1,000 to buy it. But that means I've got $900 now that I've paid for something that really I can't see what it is. I paid you for something, but it's not there anymore. So people are struggling with this. They're struggling to say, we know these things called intangibles exist. We know that there's a lot of money going in to develop them and to spend money on maintaining them. We know that this is what creates value in a business, but we're really not sure how we want to account for them. And so there is a movement. There's a movement which has been going really for probably 20 or 30 years and evolving and gradually developing. And today it's called integrated reporting.
I found an example online of a company that's using integrated reporting in their financial statements and so on, in their annual reports. This example is the Standard Bank Group, which operates throughout sub-Saharan Africa.
Right. This is a very good example, actually, Kathleen, that you've picked. I don't know whether you you chose this one, but this is a good example for two reasons. The first is a bank is a classic example of an organization that basically is full of intangibles. What it is, its whole business is intangibles. It's services. It's the delivery of something that depends on the interaction of individuals working with each other. Everybody thinks about banks as being everything to do with money, and they are. Money is their product. But everything that they do in terms of developing relationships with customers and everything else, that's all about intangibles. That's all about these things that, as I say, aren't on the balance sheet. And there's, like I used the Carillion example earlier, there's also a number of banks that have got into financial trouble because really things have been going on that haven't been reported that have significantly impacted the shareholders' value. Some viewers might remember there was a scandal with Wells Fargo Bank in the United States a few years ago when they opened up a whole bunch of accounts for people that didn't exist. And yet, as far as their accounts were concerned, they seem to be doing really well. So, I mean, banking is a good example. And you're showing at the top of this sheet something called Annual Integrated Report. And that's exactly what we're talking about. This is this move towards something more than just accounting information. As you can see, if you go a bit further down on this page, you can see something called annual financial statements.
Yes,
that would be exactly, that's your typical traditional information. And this organization is now trying to go beyond this. And interestingly, South Africa is a great example. They're quite progressive in this area. So
with their requirements.
Yeah, it's a very good example.
So this company is using the financial statements as always, and they're adding 3 other types of reports. And what I found interesting as well is that for each of these other types of reports, they're either following some legislation that exists around those types of reports, or they're following some kind of a standard that has been established for them.
Right.
Now, the company has many areas where they focus. For now, I'm just going to mention a few facts concerning employee issues.
Okay.
Now, the company reports what their stakeholder priorities are, and employees are one of their groups of stakeholders. So a priority for employee stakeholders is gender equity in executive and management positions. And the company also reports on the kinds of issues that the bank is facing when it's working towards meeting these priorities. So I'll give you a different example, and that is that as a whole company, they're going digital to remain competitive and to increase their competitive advantage, which means that over the last 3 years, they've engaged in a massive retraining of their managers and their employees throughout the whole continent. And elsewhere in the report, they give you the figures, the number of employees trained per year and the cost. The company has specific metrics that they use to assess employee engagement. So one of these metrics is that they have a survey. Their participation is voluntary. And last year, 74% of their employees across the continent answered the survey. It measures 2 things, basically, how employees feel about working for the company and whether they would recommend working for the company to somebody else who's looking for a position. So the company also measures employee turnover. They measure the number of women in senior management and executive positions. And they also measure employment equity, specifically in the South Africa area of their company. And there are many more details. For instance, this company offers bursaries for their employees to go back to school at night and take university courses, improve their education. And that's all reported by the number of bursaries and the cost of it and so on. They have a leadership program, and they report how many employees participated in the leadership and how many of them, how much it cost them, and how many of them were promoted to leadership positions when they were finished the course.
Right.
So it's quite extensive.
I think it's a very good example of the organizations that are trying to transition. But one of the bridges that we can build between that example that you've used and the book that I wrote is that when you look at the information the organization is providing, there's not really anything that's telling me what the overall financial impact of some of these things are. For example, you talked about turnover. How much is it costing them for that level of turnover? Why is that level of turnover? One of the questions would be, for example, that if you're saying 74% participated in the survey, that would seem to indicate that 26%, a full quarter of the workforce, haven't participated in the survey. What's the financial implication of the potential demotivation of those people that aren't participating? So I think it's a good start. I think the problem is that we don't have enough information. For example, there's a number of initiatives, for example, you've talked about that come out of that report. Diversity and inclusion, very critical issue these days. In fact, diversity is a very interesting one, especially in the financial services industry. There was a survey that was done a few years ago that said, actually, there's a return on investment. The more diverse your workforce is, the more productive and higher performance your organization is. So organizations shouldn't be doing it because it's good corporate social responsibility. They should be doing it because it's the right thing to do organizationally. And so all of these investments that the organization is making to do the right thing, the shareholder has no real visibility as to what proportion of their total expenses are going into doing those things. For example, you talked about the training. Everybody's going through digital training courses. That's an interesting event, but my question would be, how much money have they spent in total? And I think you mentioned they show some of this information on their report. But in a way, that's creating an asset. In other words, they've invested in those people and presumably they're hoping for some long-term benefit from that investment. So it's like an investment for the future. And yet all of that money has come out of their current earnings. It hasn't been identified as an investment into the future. I would like to know two things, and this is where I think the accountants should be involved here. First, I would like to know what it's costing the organization to make those investments and how much is it being charged against current earnings. So I've got some idea of the impact it has on the current use of my money. But the other more important thing I'd really be interested in is if they've spent X million rand in South Africa to do this. If they have a 10% turnover rate, that means every year they're losing 10% of that investment that they've made. Is that showing up anywhere in the financial information that they're actually losing what I would call intellectual capital? Something that they've spent money in, they've invested in. When those people walk out of the door, that's a loss to the organization. As a shareholder, I don't see any of that type of financial information. So if, for example, I have to write off a piece of equipment because it's failed 5 years before it should have failed, then I take a financial write-off in my accounts. I can see that. But if my assets, my people just walk out the door, I have no visibility of that. So I think accountants could build a better financial bridge between these things that are important, like the things that you identified, and the amount of money and where it's going to.
Your points are very well taken. There are actually some answers in this company's report to what you were raising, but I think what you're doing here is that you're giving examples that would apply more broadly to other companies that are not engaged in integrated reporting. And that's the point that you're making.
That's exactly the point. And that's the whole point of the book, is that I think rather than sort of trying to figure this out with accountants just sticking to the financial information, I think the accountants should be front and center of saying, look, we account for the money. We're not providing good visibility and transparency for both where the money is going and where the benefit of where that money is going is either being maintained and valued into the future, or whether we're losing it because of the way we're running the business. In other words, those intangible assets that we've created, have we still got them? Have we been able to retain those things, or are we losing them? How much are we spending to sustain them? Yeah, like your digital training, I'll come back to that again. You can't train people digitally. In other words, as we've said for years, training is not something that stops when you leave school. These days, training is something you're doing all the time. So these people that went through that digital training, there will be an ongoing commitment to have to train and develop and educate and upgrade those people. It shouldn't be seen as an event that you report on. It should be seen as really a continued flow of investment into the workforce that creates an intangible asset for the business.
So you're arguing in your book that the accountants should be creating not just financial statements, but other types of statements to go along with the financial statements.
I think accountants should be able to take the lead, because everything that you do in an organization typically costs money. And so somebody has to build the bridge between the financial reporting that's been established for a long time and the new world that we have today, which is a world where a large portion of the money is going into things called intangibles, which typical accounting reporting doesn't handle. So in other words, people are working hard to report on these things, these intangibles, in their integrated reports, like the example you showed. But I don't think we're building a good enough financial bridge between the financial information and the information contained in those other reports.
And the information that the accountants would need to generate these other types of reports would be available somewhere in the company's records and with the interviewing the managers and so on. So most of that information would be available if they asked for it. Is that correct?
I think a large proportion of it would be, but I think it would be a case of having to ask the question, what should we be measuring and what information should we be capturing? Because in some cases, the expenditure isn't being captured today in a way that really gives us the insight into how much is being spent on those intangibles. In many financial reports, it's reported at a very high level. It's not at the granular level. And some companies may have the information, some companies may not have that information. So it would be, I think, fairly straightforward to get it. But I don't think all companies would necessarily have it available.
So accountants, you're arguing then that the accounting profession needs to take the leadership in developing momentum amongst companies and amongst their own profession for this transition to a more integrated reporting.
Excuse me. Yes, absolutely. I think the danger is that one of the things, if you step back from the way any organization operates, it's a system. Everything that the organization does has an impact on the end result that it produces. So what everybody is doing in the organization in some way supports what comes out of the end of the organization. Hence the concept of integration and integrated reporting. Rather than talking about just shareholders, the idea is to talk about stakeholders. everybody who has an interest in the whole system. And I think that's the key, is to look at the organization as a system and report on the health of the system. And so I think that's, what the direction we should be heading in.
Okay, so your book is actually contributing to this momentum to move forward towards integration. Where can people get a copy of your book?
The book is available on Amazon. You can get either a Kindle edition, or there is a paperback edition, which is the one sort of, I think, looking over your shoulder a little bit. The cover on this, people will actually find out that the cover that's on Amazon right now is slightly different from the one that's over your shoulder, and there's a reason I won't go into, but okay. The book is the same, the cover is just slightly different. But it's more than just making the point that we need to change. The book actually provides a framework as to how we might do this. It takes all the learning that accountants have done over the last 100+ years of financial reporting and says, if we have all this maturity and understanding of how the finances work, here are some concepts we can actually take and apply them to the other things that need to be reported. So it's more than just a history book. It's more than just a here's where we are today with the problems. It's actually a here's where we might go in the future.
Okay. Thank you very much for chatting with me today about this, Nick.
It's been a pleasure, Catherine. Thank you very much for the opportunity to do it.
Okay.